Hi, Todd VanDenburg here with VanDenburg Capital Management and another Uncommon Sense update. So here we are, we're getting towards the end of January and no way to sugarcoat it. The markets are just not looking good. January's ended up being a pretty bad month with the markets approaching what they call a correction. It's around 10% away from the all-time highs. So when you look at the chart for the last month, it just looks bad. And again, no way to sugarcoat it, other than to try to add some perspective. So I'm going to throw up a couple of charts here. One that shows the last 12 months. So basically, the markets are right now back where we were around July of last year, 2021. And then when you contrast that to like a 2-year chart, you can see that we've had substantial gains. So while nobody wants to see the market pull back and see account values go down, the markets don't just go straight up forever. Sometimes they go down. And so now what I want to talk a little bit about is, why is it happening now? So as many of you know, we've got a few things going on in the world right now. The Federal Reserve is talking about raising interest rates to try to address the fact that inflation is high. And, I mean, that's good, I guess. The inflation is high, but it's not because of, interest rates are too low. And, that's not the root cause, at least in my opinion. The root cause of the inflation is we just are awash in dollars, too many dollars, chasing too few goods. And through the pandemic, we shut stuff down. So we shut down our ability to provide goods and services, while at the same time we were filling the economy with extra dollars, either through the Fed or through the US government borrowing. And that's sort of the magic bean of inflation, right? It's you have way too many dollars chasing too few goods and services, and go figure, the prices go up. So as the Federal Reserve talks about raising interest rates, and also potentially, it's called tightening. So they've been printing money. The Fed has been printing money for 10, 12 years now to try to stimulate the economy. And they've announced that they're going to slow that down. So notice what I just said there. They're going to slow it down. So they're not even talking about pulling back some of the money that they've injected into the banks and what they thought would be into the economy. They're just talking about slowing down the amount of money that they continue to give the banks. So we're a long way away from having any real impact, having the Fed's actions have any real impact on the US economy. So what this looks to me like is something that I've referred to in the past as a taper tantrum, right? So the Federal Reserve starts talking about they're going to taper their buying activities, and the markets correct. They don't correct every time, and therein lies the rub, right? If the markets corrected every time the Fed tapered, I'd be a proponent of selling when the Fed announces tapering. The problem is it's not 100%, because it's not always a bad thing. And I talked about this in a prior update. The banks are sitting on so much excess cash right now that they're not even trying to put into circulation, that even if the Federal Reserve did completely eliminate their bond buying activity and actually start pulling money back from the banks, if they pulled back $50 billion a month from the banks, it would be roughly 7 years or more until they pulled all of the excess capital out of the banks that the banks have just been sitting on for the last, several years at least. So I'm not at all concerned about, what the Fed's doing. I don't like how the markets are reacting to it, but, market volatility is not a sign of economic collapse. Sometimes it just is volatility. So I want to show you a couple of things here that explain why, while again, nobody loves a correction, now, in my opinion, is not the time to try to guess, okay, well, I'm going to sell now and I'll get in when it bottoms. The bottom could be today. The bottom could be tomorrow. There is no telling when there's no math behind the selling. So let me show you a few things that maybe help bolster why I am not overly concerned about the long-term prospects or even midterm prospects for market values. So the first thing I want to talk about is U.S. GDP. So yes, U.S. GDP got hit pretty hard as a result of the pandemic, but it's come roaring back. And here's a quick chart that shows that it's not near the lows of the pandemic. And that's because, again, the government has injected a bunch of money into the economy and people have been spending it. So spending it, that takes me to my next chart. Personal consumptions. Personal consumption is off the charts. It's not even close to slowing down. There's no trend that indicates that it's going to. And when you just consider again how much cash people, individuals, and businesses and banks have on the balance sheet, which is part of the reason for inflation. But when you look at all that cash, what you see is consumption is not likely to diminish. If anything, as more and more people get back to work, they're going to have even more money in their pocket, and consumption should continue to go up. Now, as far as getting people back to work, while the unemployment rate is low and it's continued to fall, I think President Biden in his recent press conference, talked about how he's added more jobs in the first year of a presidency than any other president, and look at what a great sign that is. Well, I mean, yes, that is technically true, but we also have to look at the fact that those jobs weren't created. They really were just put in hibernation because of the pandemic, and they're just coming back now. So, I mean, if the government shuts down, the U.S. economy again next week, which doesn't look likely, but if they were to do that, we'd lose 10 million jobs overnight. And then over the course of the next year, we'd probably pick them all back up again. And then we'd have a great looking year of job creation. But is that really job creation? So let's not get all worried about the hype that politicians and the media starts to push on us. Let's look at what's really happening in the economy. And again, as I pointed out, consumption is up, GDP is up, cash on personal balance sheets is up. There is one thing, one other thing that I haven't mentioned yet is building permits. So I refer to building permits a lot because it's really a forward-looking indicator. I mean, home builders are not in the business of building homes that can't be purchased. Sometimes they overbuild, that is true, but you can tell a lot by where people put their money. And builders right now are getting building permits because they just see that interest rates are still near historic lows, right? I mean, anybody who thinks that a 1% raise or increase in interest rates is going to stop people from buying homes has really never considered what interest rates have been over the history of our country, because interest rates have been 5 times where they are now, and people still manage to buy homes. So I digress. The building permits have continued to go up, which is a really great sign. And as we look at what's going to happen through the rest of the pandemic or through the rest of COVID, I think, and this is just I wouldn't call it a canary in the coal mine, but it is a reasonable indication that things are starting to change. And that is, some news came out regarding one of the companies that really benefited from people locking down, and that's Peloton. So Peloton makes bikes and treadmills and things like that. And over the last 2 years, I mean, they've just been killing it, right? People can't go to the gym. They don't want to go to the gym. They don't want to be around other people. They don't want to catch COVID. So they've been buying Peloton equipment. Well, Peloton orders have just fallen off a cliff. And it's not because people don't have money. It's because people are starting to get back to find ways to just live their lives with this COVID virus, the Omicron variant or whatever variant comes after it. And as a result, they're going back to the gym. Now, people can argue whether that's a good thing or a bad thing, smart or dumb, whatever. But it is what it is, right? People are not buying Peloton equipment, and instead they're heading back into their local gyms because they just seem to understand that, this COVID thing is something that we may need to find a way to live with. And so they're basically venturing back out again. And since I split my time between, Texas and California, I can't tell you that, people are venturing out more in California. In spite of the recent surge in Omicron cases, people are still, trying their best to find safe ways to get on with their lives so that they're not just restricted to their own houses for another year or two. So long story short is, no, the markets right now, they don't look good. But in my opinion, this is just emotion selling. It's institutional investors who are trying to find ways to manipulate the market so that they can make more money. Now, that's not to say that we're telling anybody to use your emergency fund or your cash reserves to buy in now because it's a great buying opportunity. If you're like, you work at a job, you're contributing to a 401k or an IRA or a SEP or a 403b or whatever your retirement fund is, keep doing that. This is a great buying opportunity for those kind of people. But we're not suggesting that anybody should abandon their discipline of keeping a good solid emergency fund so that they can buy in now because the markets are down a little bit. We're recommending everybody maintain your discipline. This is not a time to sell. It's just volatility. And the last few years have shown us that volatility in today's markets, it's just a little more violent than it has been in the 18 years I've been doing this. And so we just got to get used to the new normal. When things get volatile, if they're not backed up by fundamental issues in our economy, then in my opinion, we need to be patient. And that's what we're doing here. So that's a pretty long update, but things are pretty crazy right now. And the last thing I'd hate to see people do is just bail out of the markets and add to the downward pressure that's getting placed on by institutional investors right now. If you're an investor right now, it's time to be patient. Keep your cash in reserve and just weather this out. And in a few months, we'll probably look back on this and go, yep, that was another example of just volatility. So if anybody has any questions about this or any other financial matter, please, post a reply to this update, send me an email, give me a call. I'm happy to help. I'd rather you ask a question so that we can make smart choices today versus come to me in 6 months because you made a bad choice in a vacuum and we have to find a way to recover from it. So that was your update. I hope you enjoyed it. If you did, give us a like, give us a share, and I'll be back again soon with another Uncommon Sense update. Thanks for watching.
If you'd like to be the first to hear of more Uncommon Sense updates like these, please click the subscribe button below. We'd really appreciate it. Thanks again.